Notably, the Nifty IT index rallied nearly 17% for its best month in about 6 years. For more on whether or not this is the start of a good thing for Indian equities, we're joined now by Feroze Azeez, who is the joint CEO at Anand Rathi Wealth and joins us today from India to talk about what this means for the markets. Feroze, it's good to have you with us. Let's start off first with your broad assessment and impressions of earnings. Many have said that we've seen better than expected report cards, that is, from various sectors in India. Would you say that so far so good and that it's been a rather impressive and encouraging earnings season so far based on the report cards you've seen?
Good morning, JP. Yes, the earnings have been better than expected for this season. You see about NSE 500, 261 companies have actually declared the results, so it's still early times. The expectation of Nifty earnings for us, generally we try and measure it in rupees, not just the growth. Last year we closed at 1190 rupees of earnings per piece of Nifty. We had estimated 1186, so that was as close as it could get. This year we again look at about 11% earnings growth. Nifty or any indices for the index for that matter goes through some changes. So we look at constant constituents earnings because last year there were 4 changes on Nifty. So constant constituent earnings for us, the estimate of the growth is 11%. I think we've seen large cap stocks having delivered 8.7% earnings growth for this quarter. Small cap and mid caps have shown larger numbers, so almost about close to about 20% earnings growth so far. So I think that's a pleasant surprise. But I think when we look at microscopically every quarter earnings, we generally, as analysts or capital market participants, miss the bigger picture. The earnings growth for the last 3 years has superseded price growth by about 3.2%. And that's the case for the last 10 years as well. The earnings growth has compounded at 12.9%, whereas the Nifty has compounded at 9.4%. Every time you see 10-year lagging of price and 3-year lagging of price relative to earnings, you see that the market's hope are least, but the probability of outperformance is highest. So I took you a little back in terms of earnings growth for the last decades has underperformed 3% compounded, little over 3% compounded its price. So that's why Indian markets seem very attractive, not from past performance standpoint, but from future standpoint.
Yeah, and I guess these earnings also providing a really strong underpinning for any case of a rebound for the Indian equity markets. I did want to go back to one thing you said, Feroze, and correct me if I'm wrong, but it seems that you indicated a little bit of a surprise here in that large caps came in at 8% growth, and if I'm not mistaken, small and mid cap stocks coming in 20% higher in terms of earnings growth. Does that indicate that you were mildly surprised on the upside with how small and mid cap stocks did? And is that a case that maybe the small and mid cap stocks have more potential in this potential rally as compared to large cap stocks? What are your thoughts there as to whether or not one should focus more on small and mid caps or large cap based on the earnings results and the difference in how the earnings results have panned out?
Yes, so yes, you're so right. The earnings growth, if I have to be very specific, the earnings growth of companies which have declared results, NSE's Midcap 150, which is what mutual fund managers in India are mandated to track. So we all should track that index because the markets, equity markets are buoyant because of mutual fund inflows in India, domestic flows. So that's actually so far grown by 24.8, and the small cap index, which is NSE Small Cap 250, of course, these are incomplete results. That's 46%. So should one look at mid cap and small cap? Yes, definitely yes, but very, very selectively because the valuations at certain counters are extensive. And if institutional players start booking profits, and they have in certain counters, you see a lot of downside. So you have to be very selective. You have to build those bottom up, those stocks which fund managers are adding to their portfolio. Now, I'm going to give you one number which we have not released as of now. It is a report which we'll release, which is how much is the mutual fund AUM as a percentage of free float of NSE 500. In India in 2009, mutual fund as a percentage of NSE 500 free float was as little as 6.7%. Now it is 23.8%. What does it mean? 1/4 of the NSE 500 free float can be absorbed just by mutual fund investors currently, and that's going to be 33% in the next 3 years. So when that happens, you have those counters where there there is domestic institutional interest. Fundamentally, those are the counters which will be buoyant. And this 6.7% moving to 33% in the next 2-3 years is the reason why our reliance on FII inflows have been significantly lower. Not on the currency, but definitely on the capital markets.
Yeah, so I mean, a lot has been made also about foreign currency, about foreign investor inflows, not being shying away from Indian markets until at least the last month and a half, that is. And as you rightly pointed out, a lot of this also in earnings. But what part of this, what part of that deep liquidity pool also plays a part in perhaps enticing some of these foreign investors to come back in? Because some have said that's one of the reasons why the IPO pipeline has also looked very attractive for foreign investors coming into India. Does the same case apply for equity markets in general? Meaning that does a deeper liquidity pool also play a part in making this more lucrative now for investors looking for a reason to revisit Indian stocks?
Absolutely, JP. Yes, because there's somebody who takes the first move, and that brings in courage for the FIIs to come in. Of course, I said in January that FIIs would come back to India. They came in February, but after the war, March was one of the worst outflows. Almost we lost a little over $11 billion of outflow. And of course, after that, after the war, months have been bad. But July again became a positive number, reasonably decisive positive number. So that's one great news. And this I said in May, end of May when I was on your channel. So coming back, do these inflows bring in FII flows? Yes, FIIs generally use passive indices to replicate themselves on the emerging market index. So what we should ideally, which we solve for mathematically, is MSCI Emerging Market Index, which has India's share. $1.8 trillion follows that index. 0.8 trillion is passive, 1 trillion is active. August review, which is going to happen mid of August, and the November review, I think India will be a beneficiary of inflows. It has lost money in every region to Korea, Taiwan, China. But since Korea has, and again, I had said this on your channel, that Korea will find that was a gamma squeeze, short gamma squeeze, that has to stop. When that stops, rejigs will become a positive inflow. And that's why you see July has been good in a preemptive move for front runners who front run an MSCI emerging market index. So August should be a good month from an FII flow. Both domestic inflows bring in courage for FIIs, and also these rejigs, which have always for the last 6-7 quarters worked against India, will now work for India, at least for the subsequent two rejigs of FTSE and MSCI.
Feroze, can I go into one other sector that seems to have impressed and surprised some others who are on the outside looking at? That's the IT sector. Many were concerned, that is, about the rally being more due to the AI trade unwind and also disruption risks from AI remaining. But as we saw there a while ago, the AIT sector strong outperforming, surging about 17% higher in July. What are your thoughts on that, and how you're if you were as pleasantly surprised with how well the IT sector did in the month of July vis-a-vis that of the broader Nifty?
I'm not surprised, but I'm of course there's a pleasantness to it because I'd called for it. And if you look at the May 22nd interview on CNBC, your channel, the Asia channel, you would see that IT index was at 29,000. I said that it is overdone. You also have, of course, we had lost out on the LLM. We had also lost out on the hardware story. But I think we still have immense resilience. Indian IT sector, of course, has disappointed a lot of people domestically because their innovation levels were low. But that time it was 29,100. I think you played the ticker as well. Now we are at 30,708. It has outperformed the Nifty. Whenever in good results, in bad results, if the stocks does well or vice versa, that means the current ownership is a very solid fundamental ownership rather than a momentum ownership. So I would say the IT sector has the potential over the next 3 years to beat Nifty by about 3% to 4% compounded. And that's generally our objective when we rotate into sectors.
Yeah, so definitely the IT sector is something to keep watch of course. And one thing, of course, that we're keeping watch of in the coming days, Feroze, is the RBI's own meeting. And again, what the central bank does will be something that will determine a few things in the least to the short to the midterm. Many are saying that they will stay unchanged, but could see pressure to hike towards the year end due to inflation pressures and also maybe a hawkish Fed, perhaps narrowing that rate differential. How is Anand Rathi approaching or observing this upcoming decision from the RBI? And is this going to be important for the markets markets as we think is going to be as important for the markets as we outside looking in think it will be?
Yes, absolutely. It'll be because one sector which is largely dependent on it, which is the financial services sector, has almost about 36.9% in Nifty and almost about 23.1% in NSE 500. So this is the heaviest sector, and RBI's actions directly impact financial services. So I would say that nobody can brush aside this as not important. But the moves of RBI rate changes are a one-day move, but earnings take precedence and they create larger moves for long periods of time. Having said which, I would not be very hopeful of a rate cut or be scared of a rate hike, but I would definitely look at three things: is the inflation control in control, and what is kind of commentary you are getting there, what is the kind of liquidity which is going to be infused into the
Right.
market, and third is the growth projection. So commentary is going to be more important than the headline numbers, and I'm reasonably positive because what happens is our 10-year GSECs have played along very well. If you see our 10-year GSEC, repos have moved up and down 200 basis point, but our 10-year GSEC has been in a narrow band of
Right.
20 to 30 bips for the last 2 years, and that's the kind of stability long end of the yield curve of Indian bonds has shown, and that's what is the biggest pain for the US, which is the long-term yields don't seem to be softening. So we are not in an uncharted territory, unlike in the US when they look at 30-year yields. Those are unprecedented levels, at least not seen in the last 10, 15 years. So yes, coming
Right.
back, RBI's actions are very critical because we are speaking about a heavyweight sector, which will have a direct impact. Second, commentary is going to be definitely more important than the headline number. And if
And
you
what?
look at the RBI's action, last time I had said that there was a $5 billion swap which was announced, and that's why you see rupee better than what it was. And the slide has, and I would be very keen to see what happens to the $40 billion which has already come into the FCNR scheme, and that's why rupee stability is reasonably high probable.
Feroze, we only have about 45 seconds, but will this decision matter more for the banks or the non-banking financial sector in the fin services industry in India? Your thoughts?
Yes, I think non-banking financial services, which are high beta, this is when markets are low, you're better off in the high beta counters. So I would say NBFCs. In the top 10 of Nifty, there's just one NBFC and four private sector banks, one public sector bank and three private sector banks. Of course, you in Nifty you have more NBFCs, but I would say NBFCs at this stage will give you the benefit of the higher beta.
All right. Important to note that again. Perhaps the NBFC is also worth watching as we approach that RBI decision in the midweek. Feroze Azeez from Anand Rathi Wealth. It's always a pleasure to have you join us, and we thank you once again for your insights as we try to make sense of what this will mean for this potential Indian stock recovery if it does continue to gather steam.